Hello everyone, Chad Mays here with CEM Commercial, interviewing Ryan, who is with one of our many capital sources. So Ryan, you specialize in stated income and stated assets. Do you do special purpose properties?
Yes, special purpose properties are one of our strengths, strong properties that we lend on. Basically what a special purpose property is anything that has very little alternative use. You can't basically use a bowling alley, anything but a bowling alley. So that would include restaurants and bars, which a lot of lenders don't want to lend on because they're very risky business. We will, as long as the borrower has a middle 680 credit score. We can lend on that, cash out, refinance, or purchase. We also do gas stations. Very few lenders want to do those as well. Basically anything, like I said, the purpose of the building and the property is just for that.
Okay, for like example, light industrial or assisted living facilities or funeral homes, stuff of that nature?
Those three are all obviously definitely in that property tier. And a number of reasons also that I didn't mention why they're there is also you might have some environmental issues, much like a funeral home, the chemicals that they use, or like I said earlier, a gas station because you have tanks in the ground. So there's environmental concerns, which also a lot of other lenders don't want to touch, where we'll do the environmental due diligence, but once we do that, we have secured the safety of the property. We'll lend on it.
Okay. Do you only go by the debt service coverage ratio?
No, we look primarily at the debt service cover ratio because the value of a commercial property is directly dependent on the income that it produces. Not all properties produce income. Many are owner-occupied by the business owner, so therefore they're not paying themselves rent. In that case, we can go by a sales approach, find other similar properties nearby and compare its value to that.
Okay. What is your combined loan to value?
Combined loan to value is on an owner-occupied property, we can go up to 90%. So what that would entail would be on a purchase deal, a business owner would get the first loan through us. They can get the second loan through any entity. Many times it's through the current owner of the property, and it's a seller carryback. As long as the terms of the seller carryback are reasonable and make sense to us. It's not a balloon note in 6 months, for example. We can do the loan.
Okay. Do you have any limitations on cash outs?
No. As far as cash outs, we want to make sure that the cash out is there to improve the business, whether it's they can refurbish the property, they can buy materials that they need to do more business, they can buy inventory, they can hire somebody with the money, they can pay back taxes, they can use it to buy other properties and other real estate.
Great. You mentioned earlier in your introduction video that you do permanent financing. What does that look like?
Well, basically, with banks and with hard money sources and other lending sources, they tend to lend on balloon notes. We're not balloon notes. Our loans are permanent financing. They're amortized anywhere from 15 years to 30 years. We have adjustable rate mortgages or adjustable rate notes, and along with that, though, there's no balloon note. They don't have to pay it off in full at any certain time other than the amortized amount. They can even get a 30-year fixed loan if they want with us.
Great. Thank you, Ryan.